So now we've got those key concepts covered. What we want to go into now is types of investments and the risk and reward associated with each one, because they're all different. And we'll start off with term deposits. So term deposits is where we've got some money saved and we put it into the bank, and we put it into the bank for a set period of time. So we can't access it during that time. That's a term deposit. Generally deemed to be relatively safe investments if they're invested with your top tier banks. A little bit different from a savings account, because savings account you can dip in and out of it as you want to. Term deposits you can't. You've got to wait till the end of the period. If you break that period, then you pay penalty. So that's the difference between a savings account and a term deposit. And if you have a look up there, term deposit rates, they're pretty low at the moment. And so when I prepared this, those were the interest rates for some of those top banks. Then you also have what is called bonds or fixed interest, and that's when you lend money to a company to do something with. They'll have their own plans and they'll say to you, we will pay you this amount over these periods at this frequency. Now they can be high risk or low risk bonds. It just depends on the type of bonds. So when you're investing with government and with larger sort of companies on the stock exchange that have been around, they're deemed to be a little bit safer. But sometimes you have unsecured bonds, and they will probably pay you a higher rate because you're carrying higher risk. If something happens and you've invested in an unsecured bond, you are at the bottom of the list to be paid out when the company fails. So, be mindful of whether it's a secured bond or an unsecured bond. And even if it is secured, there's still a ranking. So if a company goes bust and has nothing left, even if you've got a secured bond, you won't get anything back. If you're unsecured, you're not going to get paid out until the secured people have been. So when they say secure, usually there's an asset. So when I buy a house, the bank takes a mortgage over the house. So if I don't pay it, they've got an asset that they can take and resell. So that's usually what they mean when they talk about secured. Then you've got property. And there's investment property, there's commercial property, and then there's property funds. So they all invest in a tangible asset, but what you directly invest in is different. So there is a residential property, which is a house, so you can invest in that. A commercial building like this one, where you're paying, where the tenants pay you a lease income, or you can invest in listed property companies like Kiwi Property, who bought 50% of the base. Even though the tribe sold 50% of that, tribal members could have invested in Kiwi Property and indirectly had a share of the base through that way. So that's the three different types of property investments. There's lots more, but those are your main groups. And if you look here, you can see what the long-term trend of property has been in this country. Now, works well for investors, doesn't necessarily work well for people trying to buy a house. So those are the two sides of the coin. And if we look at an example, back in 2002 there was a house bought in Takanini, 160,000, the rent was 285, so our income return was $285 a week in rent. Then you can follow the increase in value up to the right hand side to the point where that house is now $620 in rent. And so if you bought that house back then and you kept it and you now get $620 in rent per week, you get quite a high return. Whereas if you bought the house for just under $700,000 now and got $620 return, your return is much lower because you're getting a high amount of rent, but relative to the value of the property, it's not as good as it was before. So those are examples of how time and property come together in an investment context. The next type of investment is what we call income shares. So we talked before about income returns, And so you have certain shares on the stock market that pay dividends. And they tend to be really mature companies. They've been around for a long time. They're quite solid. There's not much more they can do. And so they tend to pay out dividends, much like our land trusts and incorporations, dividends. And we get income off our land trusts and incorporations from the shares we have. It's very, very similar concept here. Only difference is we don't buy into our land trusts and incorporations, but you have to buy into these ones. And you see the types of companies, your energy companies, infrastructure, telecommunications, banks. They're fairly stable companies. That doesn't mean they'll always be stable, but they are at the moment. Disruptions happening everywhere and we don't know what will happen to them. Then you come down into your growth shares, and I talked about Xero before. And so they're the company that's never paid a dividend, but you can see how much the value has grown. So if you bought $1,000 worth of shares when they started, it's probably worth $100,000 now. So that's just different types, but there's higher risk with growth than there is with income. The next kind of investments in a big bucket is direct investments. And so that is where we either directly operate a business ourselves or we invest directly into a company. We don't go through anyone else to do that. So TGH is, it's probably got a mixture of direct investments. So the hotel, it doesn't run it directly, it's got a management company, but that is a direct investment of ours. Very similar to maybe milking systems. In that case, we invested into that company, but same again, we don't run it. So there's two types of direct investments. You've got private equity and venture capital. So private equity is usually investing in existing companies, and then venture capital is investing in kind of startup or yet to be proven companies with very positive prospects. So those are direct investments. My sense on those ones is that unless we're really experienced or have run businesses or know the industry that we're going to invest in, I'm not inclined to invest in direct investment unless you've got the right people making that call. They know the industry, they've run these businesses before, they know how to get value out of them. And then venture capital, that's high risk and high return. So that's, your Twitters and, those kinds of companies, Ubers. But for every Uber that made it, there's probably 3 or 4 companies that didn't. So that's the risk. And then, I guess the main one, which is our marae. We have to maintain our marae so that it takes care of us and we take care of it, and that future generations have that same opportunity, but they also have that same obligation. So that's how that comes in. Each of those investments has a different risk and reward profile. So some of the investments are lower risk, therefore the chances are you'll get a lower return because it's reasonably safe. And so at the bottom is your cash in the bank and your term deposits. Then the next one up is fixed interest. So we talked about bonds. Then you're moving on up to property. Then you've got your income shares. Then you've got your growth shares. And then you're moving into that private equity piece. So different types of investments give you different types of returns and have different types of risk. And so you can see on the left is sort of those are your income investments. Go to the middle. Those are kind of your mixed zone where you might get income and growth, and then you move over to the right and that's more exclusively the zone for growth investments. We talked earlier about portfolio and another way that people refer to that is diversification. And so that's looking at the different types of investments along that line and saying what mix of those investments should we have in our portfolio. And that will depend on what you want. If you want to get more income out of your portfolio of assets, you might have more income investments in your portfolio. If you want growth type investments, you might weight it that way, and if you want balanced, you might weight it somewhere in the middle. So its diversification refers to having a range of investments in your overall investment portfolio. And if we look at that for Hine Taiwa and her seed potato collection, she'll have some varieties that can grow in just about any conditions, anywhere, and they're reliable. So they will produce a good crop every single year. But because they're so easy to grow and produce, a whole lot of other growers are probably doing that as well. So the price that she gets, may be lower relative to other varieties that are more difficult. And then you move up towards the right where you might have this variety of potato that is highly, highly valuable. It might be only by the exclusive eateries or something like that, but it's hard to get it right. But if she gets it right, she gets paid really, really well. And so that's up at the growth end. And so all throughout that curve, you've got different mixes of risk, and it could be animals. So a risk might be animals getting into the crop. Well, you manage that by putting up a fence, so that's how you manage your risk. It could be someone coming in and stealing her crop. It might be that she's got a prized collection and it's highly valuable and someone else wants it, and so they come in and take it. And so you've got all of these risks associated with the higher returns. So that brings us to the end of that section. Any pātai?
Kia ora, Missy. Our whānau wanted to ask about investing in our own whānau and what the marae could do to lessen the risks of doing that.
Yeah. So investing in your own whānau would probably be considered a direct investment. And so you remember those are up the higher risk end of the spectrum. And so when you're at that higher end risk, we need to make sure people understand the business that whānau might be going into, understand the industry and understand how to manage and run a good, successful business. If you want to do that, you have to think about what is the risk and how do we manage it.
Kia ora, Missy. Just a quick pātai. If your marae have a term deposit sitting in the bank that doesn't seem to be growing, is it common practice to change banks, or what is the common practice?
I think it depends on who's common practice, but it's good to review your investments and see whether they're performing as you want to. You can change banks, but largely the difference in interest rate is really minor between all of the banks. So I think the main thing is to find an advisor who can step you through it and outline to you what's the benefits and the risks of each of your options. That's probably the best thing that you could do. Get the advice of an expert.
Kia ora, Missy. My Marae trustees are very old school. So we're looking at some tips to find ways to try and convince them to be more interested in things such as investing our money. What would you suggest?
Come to a wānanga like this. So I think, it's important that they trust, and so they've got to find someone that, one, they trust, and two, they understand. And once they understand, it's easier for them to open up a little bit to what the options might be. It's pretty hard if they either don't like the person delivering the message, or they a lot of it's usually fear, and because some of our older generation, they know what loss feels like. We've come into a situation where we think we know what it feels like, but actually they've experienced it. And so we've got to be able to help people get comfortable with understanding both sides of the coin. A lot of our people only think about the loss aspect of investment. They don't think about the risk of what they're doing now. So they think safety, but they don't understand the risk associated with what they perceive to be safety. We have to get them comfortable, first and foremost.